Welcome to the National Credit Awareness and Resolution Association podcast, your source for navigating debt repayment challenges during tough economic times. Today we'll explore how to effectively use Creditor Tools, specifically financial statement requirements. NACARA aims to bridge the gap between debtors and creditors as a paradigm shift allows debtors to propose their own repayment solutions. We'll share insider tips to help you leverage this knowledge and strengthen your position. Let's get started. Financial statements and tax returns, the reporting requirements. Creditors will require both a certain type or quality of financial statement reporting, together with the frequency of such reporting. These include company-prepared financial statements all the way to CPA-prepared audited financial statements. Financial statement quality refers to the level of assurance needed by the creditor. So, creditors that require a certain level of assurance will be prepared by an independent certified public accountant or CPA according to a required accounting framework, generally accepted accounting principles, or GAAP. The financial reporting frequency can be monthly, quarterly, or annually, and will typically include at least the balance sheet, income statement, reconciliation of equity, and cash flow statement. The required type of financial statement and tax return submission is often matched up with a loan amount and consideration of the corresponding collateral as follows. First, company-prepared financial statements and tax returns, say loans up to $1 million. Management-prepared financial statements carry the highest degree of risk in terms of the creditor not being able to rely on the accuracy and completeness of the financial statements. The quality of the financial statements can vary. For very small companies, if a CPA assists in the preparation of company-prepared financial statements, there will be no verification of accuracy or completeness of any of the information, nor will there be any assurances provided by the CPA. Typically, CPAs will perform this service in conjunction with other bookkeeping, accounting, tax, or transaction processing services he might also be providing the small business owner. Company-prepared financial statements may not be worth much more than the paper they're written on if the creditor does not have confidence and trust in the debtor. Tax returns will serve as documented support for such statements. Next, CPA-compiled financial statements and then tax returns for loans maybe between $1 million and maybe say up to $3 million. Compiled statements are based on the amounts provided by the business owner. They also offer no assurances or opinion from the CPA because there is no verification needed for this statement type. That said, the CPA is required to read the statements and consider whether the format is appropriate and that there are no obvious material misstatements. Small businesses generally use accounting software to generate their internal financial statement reporting, but creditors will generally require these small companies, for these smaller loans, to have their statements compiled by a CPA. Naturally, a compiled financial statement is less expensive than the next level up, which is the reviewed financial statement. Speaking of that, a CPA-reviewed financial statement, of course we're talking about tax returns coming too, these might be for loans anywhere from maybe say $3 to $5 million. Creditors will often require CPA-reviewed financial statements where there are certain limited assurances provided by the CPA as to the accuracy of the information and that there are no material modifications needed to bring them in compliance with the applicable financial reporting framework like GAAP, Generally Accepted Accounting Principles. CPA will perform analytical procedures and inquiries to verify information in accordance with accounting principles generally used in the business and have a sufficient level of knowledge of the business's industry. A reviewed financial statement is less expensive, of course, than the next step, the audited financial statement. The CPA audited financial statements, say for those loans over $5 million, creditors who require the highest level of assurances will require audited financial statements and their accompanying disclosures. Audited financial statements add credibility to the reported financial condition of the debtor. The CPA will issue an opinion as to if the information was prepared in all material respects with applicable financial reporting requirements. It offers reasonable assurances that the information is free from material misstatements. The CPA will perform internal controls testing to safeguarding assets and the segregation of duties, and get confirmation and evidence of the amounts and disclosure listed in the statements, like, for example, cash, securities, accounts receivable balances, inventory levels, fixed assets, accounts payable, debts, revenues, and expenses. They'll actually get verification. Based on procedures for inquiry, inspection, third-party verifications, and analytical analysis. Audited statements take the most time and are the most expensive, of course. Common financial statement protocols. Financial statements should be prepared on an accrual basis unless the statements are for a single-entity commercial real estate holding company or for small commercial loans. Schedules for accounts receivable, payable, and inventory should also be made available if applicable. The schedules and the financial statement dates should all match. Most financial statement packages will include pro forma projections or budgets for the upcoming year and year-to-date interim financial statements. Asset-based lines of credit may necessitate a correspondingly higher quality financial statement than what appears above as pertaining to loan sizes. All business financial statements and business tax returns, including personal financial statements, will need to be signed and dated. A creditor will usually affix a signature stamp on the documents for the owner to certify, in fact, that the statements are true and accurate for the purpose of the creditor lending the debtor the money in the first place. This short ad is sponsored by the Debt Crisis Problem podcast. Attention, listeners. Please join us at tunabudget.com to tune into the Debt Crisis Problem podcast, where in plain English we discuss the 20 risks that could soon fuel a serious economic downturn. We explore these critical risks and offer practical insights for navigating financial uncertainty. Join us for thought-provoking discussions that encourage transparency and awareness. Subscribe now to stay informed and be ready for whatever comes next. Next, personal financial statements. Next, let's talk about personal financial statements. Personal financial statements are required for all individual obligors or guarantors. Such debtor guarantors will be asked to complete creditor-approved personal financial statement forms as they contain certain affirmative attestations which will bind you, the debtor. For new loan requests, these statements should be current, although a financial statement that is dated within the last 30-plus days would likely be acceptable. These personal financial statements are expected to be thorough and detail all assets with the dates of acquisition, original cost, market value, underlying debts, and so forth. Liabilities should clearly state all contingent liabilities of any general partnership liabilities and other personal guarantees. Personal tax returns need to be current as well and include the most recent 3 years of filings. Federal tax returns should include the various schedules, Schedule C, E, F, and so on, for other income and losses. The tax return should include Schedule K1 as well, and unless ownership in each business is 25% or more, then the entire tax return for said businesses would likely be requested. So why are these financial statement reporting and tax return reporting requirements important for you? The creditor is relying on your complete and accurate financial reporting. A reminder here may be in order, right? Financial statements, the language of business, used to determine whether you are financially sound or not, are fully relied upon by the creditor as being complete and accurate in all material respects. Anything else is fraudulent. Your required signature, usually in the form of an attestation that the information is valid, gives the creditor your good faith assurance that its lending decision is based on the truth, the facts. And the facts are what they are. The creditor will be making its lending decisions, whether in a workout mode or not, based on the information it has received from you. In most cases, the creditor will require verification documentation to support the cash or near cash liquidity listed on the financial statements and other valuations of the assets as well. Of course, audited financial statements are subjected to certain testing procedures and are not as likely to be confronted by the creditor. Next, misleading or inaccurate financial statements and tax returns. Now, fast forward to a very difficult and financially challenging time where your business is in serious financial jeopardy. How easy would it be for you to provide financial statements that you know are not accurate or are otherwise misleading as to their preparation date and the amounts listed? While creditors are not perfect, debtors may become less than forthright when push comes to shove. Don't go there. Do not go there. Debtors have purposely delayed submitting requested financial statement, but that happens all the time. But that does not mean it's right, because it's not. Some borrowers may even re-age the accounts receivable on the detailed accounts receivable aging report. They show otherwise materially past due accounts receivable to be current. Or a debtor can list inventory that is not actually there because it's been sold. That's why an asset-based lending creditor will order an accounts receivable and inventory audit regularly to ensure the actual AR are accurately portrayed on the books, with actual inventory in the boxes on the shelves, and not just empty boxes, which has happened. A debtor might be willing to skim inventory on a regular basis and hide it in a neighboring storage unit and claim it was employee theft. Other asset values may be inflated. All this can be done on company-prepared financial statements, right? Because there's no verification. Is that fair, though, or is that right? Is it not fraud? Of course it is fraud. While creditors usually trust their borrowers, do you think it's good for a creditor to trust borrowers who only have, potentially worthless, company-prepared financial statements, especially considering what a fraudster might do? What makes the difference? Creditors can easily spot inconsistencies and will question anything that doesn't make sense. This is why your financial statements and tax returns cannot be misleading or inaccurate. Debtors and creditors do stupid things when they are in financial trouble, and it needs to stop. Thank you for joining us. Today we covered another creditor tool, financial statement requirements, as debtors prepare to propose their own repayment solutions. We want to hear from you. Share your own credit risk memo and debt repayment experiences, questions, and recommendations with us at nicara.org. If you found today's episode helpful, please subscribe for notifications of future podcasts. Your feedback helps small businesses stay in business. Until next time, step forward and take responsibility for your own debt repayment solutions. Thanks again.